Federal Reserve raised the interest rate today by 0.25%. It is the 9th time since March of last year the Feds have raised rates. The Fed is hitting just one more hike like this year. Currently, the interest rate for federal funds between 4.75% and 5%. It's at the highest level since 2007, going back a ways. So for more on what this means for you and your family, Steve Lewit, a financial advisor and president of SGL Financial, is here once again. Steve, good to see you. Thanks for being here.
Good to see you, too.
Yeah, so highest rate since 2007 here. It's meant to bring down inflation. But I have to ask you, with the bank failures, raising the interest rate is what contributed to this. So explain to me how that balance works.
Well, the Fed didn't blink on this. In light of 2 weeks ago, we had the biggest bank failures since 2008, and that sent a clear message to us here in the economy that the Fed thinks that inflation is top priority, short-term and long-term, and they are dead set about getting the results they want, which is a 2% inflation rate. Felt that was more important than anything, went ahead and raised the rates, as you said, by 1/4 point to the highest rate since 2007. The problem is that inflation is still pretty hot, running at 6%. Borrowing is supposed to slow the economy. It's supposed to lower spending. It's supposed to raise unemployment, which I think is coming. But right now, inflation is still running pretty hot, and I anticipate, even though they kind of eased the wording about raises in the future, I anticipate there are going to be raises in the future for sure.
Boy. All right, well, let's get to the meat and potatoes here. What is this going to mean for the average American? I know it means borrowing money gets more expensive here, but put it in some kind of context for us.
Yeah, it does get more expensive. Interest rates go up. Now auto financing goes up. Student loans go up. Mortgage prices go up. Credit card interest rates go up. You can already see the housing softening in the housing market. Housing is off about 2.5% year after year. The stock market took a hit today. It always responds to higher interest rates. Dow down about 500 points, the S&P 1.3%. So that's what happens when interest rates go up. And what we need to do as investors and looking forward to have good plans to our finances, have diversified portfolios, think long-term rather than short-term, because this is a short-term experience. 2, 3 years or 2 months or 3 months, we don't know, but this will all be past us and the economy will be back to a productive economy as it is.
You mentioned that drop on the Dow here, and that does happen every time the Fed raises the interest rate. But is it something that concerns you? Do you think it's something that could be longer term?
Well, no, I think it will be a long term, but not longer like 2 years or 3 years. I think sometime next year. I don't predict the stock market because it's impossible to predict, and my crystal ball sometimes doesn't work very well. But the market will recover, whether it recovers the end of this year, which many people think, or early next year. I don't see a deep recession, which is what everybody is afraid of. I don't see a banking structure that has weaknesses in it. What happened in Silicon Valley was a very specific kind of bank with a very specific kind of clientele in a very specific circumstance. So I don't see that. The rest of the banking industry is very strong. What they are doing, however, is revisiting their portfolios and making sure that they are not in a similar situation as SVB was. So what you might see from that is a softening in lending to individuals and businesses as the banks are more careful. But this is always think long term in terms of investing, and then you'll come out on the right side of the stock market.
Steve Lewit, with financial advisor with SGL Financial. Always grateful to have your perspective. Thanks a lot.
Thanks, Ray. Stay well.
You too.